Welcome to Breaking News to Trading Moves.
Hello.
Today we're looking at material provided by a listener about the latest revenue figures from Taiwan Semiconductor Manufacturing Company. You probably know them as TSM.
That's right. And our job here is pretty specific. We need to go through the details of what they announced and figure out, based just on this material, which other companies might benefit from this news and which ones might be facing some, let's say, headwinds.
Okay, so let's start with the headline number. TSMC's Q3 revenue. What did it come in at?
$32.47 billion.
And the key thing there, according to the material, was that this number was actually higher than what the market was generally expecting.
Yeah, it beat expectations. But, the why is really important here. The material stresses that TSMC attributed this beat mostly to surging demand related to artificial intelligence.
AI again.
Yeah.
So not like a general economic upswing, but very specific demand.
Exactly. Very focused on that high-end compute stuff needed for AI.
And did the material mention who was driving that demand? Any specific customers?
Yeah, it did. Two big ones highlighted were NVIDIA, that's NVDA, and Apple, ticker AAPL. They were pointed out as helping drive these strong numbers.
Got it. NVDA and AAPL. And we should remember, this was just the revenue number, right? The full earnings report is still coming.
That's a good point. This was the initial revenue announcement, the full Q3 earnings with all the margin details, the forecasts, all that. That's expected around October 16th.
Okay. But even just this revenue beat, tied specifically to AI, tells us something.
Oh, absolutely. When the world's biggest advanced chip maker puts out a number like that and says it's AI, it sends a pretty clear signal about where the money and the momentum are flowing in the tech world right now.
It suggests that the big spending, the capital expenditure, it's really piling into AI infrastructure.
And therefore, the companies that actually build or enable that infrastructure, they're likely benefiting.
Okay, so let's talk about those beneficiaries then. The material seems to group them into a few categories. Where should we start? Chip designers.
Makes sense. Let's call them Category 1, AI chip designers. And the obvious names that come up here, based on the TSM news, are NVIDIA, NVDA, and also Advanced Micro Devices, AMD.
Why them specifically? How does TSM's good news translate directly to them?
Well, think about it. These companies design incredibly complex AI chips, right? GPUs, advanced CPUs, but they don't actually make most of them. They rely on foundries like TSMC.
Ah, so if TSMC is running well, especially on the really advanced stuff.
Exactly. The material highlights the importance of TSMC's output on their leading-edge nodes, specifically N5 and N3. These are the manufacturing processes you absolutely need for the kind of performance AI chips demand.
Billions and billions of tiny transistors packed together.
That's the game. And TSMC being able to produce those N5 and N3 wafers reliably and in high volume is critical. It means NVIDIA and AMD can actually get their designs manufactured effectively.
So it's not just about TSMC making more chips, it's about them making these really difficult chips work.
Precisely. Getting good yields, meaning a high percentage of working chips per wafer on processes like N3 using EUV lithography, that's extremely challenging. The tech is complex, the tolerances are tiny.
Right.
So if TSMC is demonstrating strength there, it basically de-risks the manufacturing side for companies like NVIDIA. It removes a huge potential bottleneck for them.
Okay, so that strong production backdrop, as the material puts it, means fewer manufacturing headaches for the designers.
Yes, and it allows them to ship more of their high-demand products. Plus, there's a pricing power angle too, isn't there?
How so?
Well, if NVIDIA or AMD knows they have secure access to the best, most reliable manufacturing capacity, and their competitors might struggle to get that same level of access or quality elsewhere.
They can be more confident in their pricing. They know the supply is there to meet the demand they're seeing.
Exactly. It gives them a supply security advantage. They can place large orders with TSMC, trust the execution on N5 and N3, and plan their business accordingly. That confidence flows right through to their own revenues and margins.
Okay, so category 1, the AI chip designers like NVDA and AMD seem like clear beneficiaries due to that reliable, leading-edge manufacturing capacity.
Definitely. Now let's move sort of downstream a bit.
To the companies building the actual system.
Yeah, category 2, memory and AI server suppliers. The material points to companies like Micron, ticker MU, and Supermicro Computer, ticker SMCI.
Okay, so how does TSMC making lots of advanced processors help a memory company like Micron or a server builder like Supermicro?
Because those AI processors don't work in isolation. They need a whole ecosystem around them. Think about the servers that house these AI accelerators. They're not standard
They
servers.
need specialized components, right?
Absolutely. And one of the most critical is specialized memory. The material mentions high bandwidth memory, HBM.
Yeah.
Micron is a key player there.
HBM. Why is that so important for AI? Can't they just use regular memory?
Not really, not for the performance needed. AI chips process insane amounts of data very, very quickly. Traditional memory, like DRAM, just can't feed the processor fast enough. It becomes a bottleneck.
So HBM is faster.
It's about bandwidth, mostly. HBM uses 3D stacking. Imagine stacking memory chips vertically, like tiny skyscrapers, right next to the processor chip.
Okay.
This stacking, plus connecting them very closely using advanced packaging techniques, dramatically increases the amount of data that can move between the memory and the processor per second. It also reduces the distance the data travels, which lowers latency and power consumption.
So it's like building a superhighway directly into the processor instead of using side roads.
That's a great analogy.
Yes.
And because TSMC is successfully churning out the AI processors that need this HBM, it gives companies like Micron the confidence to ramp up their own HBM production. They know the demand is real and the core components are available.
So TSMC's success signals that the whole system build-out is happening.
Exactly. And that brings us to Supermicrocomputer, SMCI. They specialize in putting all these pieces together, the processors, the HBM, the specialized networking, cooling, power into the actual server racks that go into data centers.
The ones designed specifically for AI workloads.
Right. So if TSMC is delivering the core processors reliably, a company like SMCI can be much more confident in taking and fulfilling large orders for these complex AI server systems. They know the key ingredient, the processor, will be there.
It reduces their supply chain risk for the most critical part.
Precisely. The confidence flows from the foundry making the wafers, to the memory guys making the HBM, to the server guys assembling the final box. It's all interconnected.
Okay, that makes sense. A strong signal from the foundry gives confidence all the way down the line to the system builders.
But the chain doesn't stop there. For TSMC to produce all these advanced chips and do things like advanced packaging, well, they need the machines to do it.
The equipment manufacturers. That sounds like Category 3.
You got it. Category 3, semiconductor equipment providers. If TSMC is boosting output on N3 and expanding advanced packaging like CoWoS, they have to be buying more tools.
And the material names companies like Applied Materials, AMAT, and Lam Research, LRCX, as benefiting here.
Those are the big ones mentioned. The logic is simple. TSMC's success, especially in these cutting-edge areas, requires massive ongoing capital investment in new manufacturing equipment.
They're expanding capacity for both the chip making itself, the front-end stuff, and the packaging, the back end.
Both. And that drives demand directly to the equipment companies.
What kind of equipment are we talking about? It's not simple machinery, is it?
Oh, definitely not. We're talking incredibly sophisticated, expensive machines. For Applied Materials, AMAT, TSMC needs their deposition tools, machines that lay down microscopically thin layers of different materials onto the silicon wafer. They also need tools for modifying those materials.
And Lam Research, LRCX.
Lam is a leader in etch equipment. Etch tools are used to selectively remove material, carving the intricate patterns that define the transistors and the connections between them. Both deposition and etch are absolutely fundamental to making chips.
Especially at these advanced nodes like N3, where everything is unimaginably small. The precision required must be incredible.
It really is. And as chips get more complex, you often need more deposition and etch steps, and the steps themselves become more challenging. So TSMC needs more tools and more advanced tools per wafer it produces.
Which directly fuels revenue for AMAT and LRCX. They benefit from TSMC's capital spending cycle, which seems to be accelerated by this AI demand.
That's the connection. But you also mentioned packaging. Let's dig into that a bit more, specifically CoWoS. Why is that suddenly such a big deal?
Right. The material emphasizes CoWoS chip-on-wafer on substrate. What exactly is it, and why is it so central to AI?
Okay, so CoWoS is a type of advanced packaging. For a long time, chip improvements came from shrinking transistors, making them smaller, and packing more into a chip. That's 2D scaling.
Moore's Law, basically.
Kind of. But we're hitting limits there, and as we discussed with HBM, moving data around efficiently is now a major bottleneck, especially for large AI chips.
So you need to get the processor and the memory closer together.
Exactly. CoWoS is TSMC's way of doing that. It's called 2.5D packaging. Imagine placing the main processor chip and stacks of HBM memory chips side by side on top of a special silicon-based layer called an interposer.
Okay, like tiles on a high-tech floor.
Sort of, yeah. This silicon interposer acts like a high-speed communication layer, connecting the processor and the memory stacks with extremely short, dense wiring. It allows them to talk to each other much faster than if the memory was further away on the main circuit board.
And these connections run through the silicon.
Some connections, like through silicon vias, TSVs do. It's incredibly complex assembly. But the result is that you can integrate multiple chips, the processor, multiple HBM stacks into what behaves like a single super-fast unit. AI workloads need this tight integration.
So TSMC ramping up CoWoS capacity is a direct response to customers like NVIDIA needing these highly integrated AI modules.
Absolutely. It's essential for the performance of things like NVIDIA's H100 or AMD's MI300 accelerators.
So the takeaway is that the AI boom isn't just about making faster transistors anymore. It's also very much about how you cleverly assemble the different pieces.
That's a huge part of the story now. And the material also mentions something about this CoWoS expansion potentially benefiting outsourced packaging providers too, even in the U.S.
Yeah, it cited Amkor technology in Arizona as an example. How does that work? If TSMC is building its own CoWoS capacity, why would others benefit?
Because the demand is just so massive. Even with TSMC expanding aggressively, they likely can't handle all the advanced packaging volume needed for the entire AI market.
So the overflow goes to other specialized companies.
Right. The OSATs outsource semiconductor assembly and test companies like Amkor. If they have the capabilities for advanced packaging, similar to CoWoS or other techniques, they can pick up volume that TSMC either can't handle or chooses to outsource.
So Amkor investing in advanced packaging facilities in Arizona positions them to catch some of this AI-driven wave, even if the core chip is made by TSMC elsewhere.
Exactly. It shows how these investments ripple outwards. TSMC's success fuels demand that benefits others in the assembly and test part of the chain, potentially even boosting onshore capacity in places like the U.S.
Okay, so let's quickly recap the winners identified in the material. You've got the AI chip designers like NVDA and AMD benefiting from reliable advanced manufacturing.
Check.
Then you have the memory suppliers like MU and server builders like SMCI getting confidence and orders because the core components are flowing.
Yep.
And finally, the equipment providers like AMAT and LRCX who benefit from TSMC's increased capital spending on both cutting-edge nodes and advanced packaging like CoWoS.
That sums up the beneficiary side pretty well. A really interconnected group benefiting from this very specific AI demand surge focused on advanced tech.
But as always, where there are winners, there are usually some facing tougher conditions.
Indeed. This kind of focused success inevitably creates pressure elsewhere.
So let's shift to the companies described as facing headwinds. The material puts rival foundries and IDMs in the first category here, Category 4, thinking about Intel, INTC, and GlobalFoundries GFS.
Right. The core idea here is competitive pressure stemming from technology leadership.
How does TSMC's strong quarter hurt them directly?
Well, TSMC's results, specifically tied to N5 and N3 for AI, really underscore their lead in the most advanced, highest value manufacturing processes right now. They're showing they can execute at scale where it matters most for AI.
And that makes it harder for competitors trying to catch up or offer alternatives, like Intel with its foundry ambitions.
Exactly. Intel, under its IDM 2.0 strategy, wants to become a major foundry making chips for other companies, competing directly with TSMC. They're investing billions to ramp up their own advanced nodes, like Intel 4 and Intel 3.
But TSMC is already delivering volume on comparable nodes.
That's the challenge. TSMC is already proven, already has the big AI customers locked in with volume production on N5 and N3. For Intel to convince those same customers, or other large ones, to switch to Intel's currently ramping processes, it's a much harder sell when TSMC is demonstrating success right now.
So it's about demonstrated execution and customer trust at the absolute leading edge. TSMC's performance raises the bar for Intel's near-term foundry goals.
It certainly makes winning those key high-volume, high-margin foundry deals more challenging in the immediate future. The outcome is that TSMC's dominance makes it tougher for rivals to gain share quickly with their own capacity ramps.
What about global foundries, GFS? They're not really playing at that N3 level, are they?
No, and that's their challenge in a different way. GFS made a strategic decision years ago to not pursue the absolute bleeding edge nodes using EUV. They focus on more mature, specialized processes, things for RF, automotive, IoT, power management.
Which are necessary, but not where this huge AI spending is focused.
Precisely. So while GFS serves important markets, this current AI boom, driven by N5 and N3 at TSMC, is largely passing them by in terms of capturing that premium revenue growth. TSMC's success reinforces that market split. TSMC dominates the high-end AI space, while GFS competes in the more crowded, often lower-margin mature node segments.
Okay, so direct foundry competitors face pressure, either from a technology gap or from being focused on the wrong market segment for this specific AI wave.
That seems to be the dynamic highlighted.
But the headwinds aren't just for foundries. The material also points to pressure based on market segmentation areas where capital isn't flowing as strongly.
Right, which brings us to Category 5, smartphone-skewed RF suppliers. These are companies providing components for wireless communication, mainly in phones. The examples given are Qorvo, QRVO, and Skyworks Solutions, SWKS.
So the argument is, even if AI is booming, the smartphone market might be sluggish, and that hurts these guys.
That's the idea. The material cites observations attributed to Reuters, pointing towards a slowdown or tapering in demand for general consumer electronics, particularly smartphones.
And QRVO and SWKS make the critical radio frequency chips, the filters, amplifiers, switches needed for phones to connect to cellular and Wi-Fi networks.
Exactly. Their fortunes are very closely tied to how many smartphones are being sold globally. If that market is slow, even while the AI data center market is hot, their business feels the drag.
So the AI boom doesn't lift all boats equally. If your primary market is consumer electronics and that market is weak, the AI strength elsewhere doesn't necessarily help you directly.
It really highlights the risk of market concentration. Being heavily exposed to the handset cycle means you're vulnerable when that cycle slows down, regardless of strength in other tech sectors like enterprise AI. Their performance gets weighed down by that specific end market softness.
Okay, so weakness in consumer offsets strength in AI for these RF suppliers. That leads us to the final category facing headwinds.
Category 6, legacy and general-purpose analog companies. Names mentioned here are Texas Instruments, TXN, and Analog Devices, ADI.
Now, these companies make essential components used everywhere, right? Power management, signal conversion, things needed in cars, factories, medical devices, pretty much everything. Why would they face headwinds?
It's less about their products becoming obsolete and more about relative momentum and capital allocation. Meaning that investor attention and perhaps more importantly corporate capital expenditure budgets are currently tilted very heavily towards building out AI infrastructure, the advanced processors, the HBM, the CoWoS packaging we talked about.
So the money and the excitement are flowing towards AI enablement.
Right. While companies still need analog chips from TXN and ADI for cars, industrial equipment, and so on, the growth story, the big spending push, isn't primarily focused there right now. General industrial or automotive expansion might be more cautious, especially if the broader economy is uncertain or interest rates are higher.
So compared to the explosive growth projected for AI-related components, the growth for general-purpose analog looks, well, less exciting.
That's the dynamic. These are solid, essential businesses, often very profitable, but they lack the hyper-growth narrative that's currently captivating the market in the AI space. So in a comparative sense, they face headwinds. Investment flows and attention are drawn to the faster-growing AI segment.
They're seen as steady, maybe slower growing, while the AI players are seen as hitting the accelerator.
Exactly. So even if their underlying business is stable, they might lag in performance or valuation multiples because they're not directly riding this specific, intense AI wave that's benefiting TSMC and its direct ecosystem so much.
Okay, that makes sense. It's a relative game.
Yeah.
So wrapping this all up, the picture from the TSMC revenue update seems pretty stark.
It really does. The material suggests a clear split in the market. On one side, you have intense reward for companies involved in the most advanced manufacturing N3 node, CoWoS packaging that enables cutting-edge AI.
And on the other side,
you have pressure or deceleration for companies maybe competing with that leader or heavily exposed to slower segments like consumer electronics or involved in more general purpose components that aren't seeing that same rush of AI-specific capital.
So extreme specialization in AI is winning out, while broader exposure is facing challenges.
That seems to be the immediate takeaway. The market is really focusing on who enables or benefits directly from this AI build-out, driven by that advanced manufacturing capability shown by TSMC.
As we finish up, looking beyond the immediate winners and losers, this whole analysis seems to point towards a pretty significant concentration, doesn't it?
It certainly does. We've talked about how central TSMC, and specifically its N3 and CoWoS technology, seems to be to this entire AI push right now.
One foundry, a couple of key technologies underpinning a massive global trend.
Which leads to a final thought, maybe a question for you, the listener, to mull over after hearing all this.
Go ahead.
If the development and deployment of what many consider the world's next crucial technology, AI, becomes increasingly dependent on the capacity and technological prowess of essentially one dominant manufacturer, what does that mean for the longer term? What are the implications for global supply chain resilience, for innovation, for pricing, if that dependency keeps growing?
That's definitely something to think about, the risks and rewards of such concentration. Okay, before we sign off, we have to include the necessary disclaimer.
Of course.
We must clearly state that this discussion is not financial advice, nor is it a recommendation to buy or sell any security. This is purely the opinion of the author of the material we reviewed.
Thanks for tuning in.
Thank you for joining us on Breaking News to Trading Moves.